again, if you don't raise your hand, I will come out and cold call you. So I just want to just prepare you for that. So since this is a practical recipe for the raise, I wanted to start tonight with a very simple question for each of you, which is, what's the one thing that you want to recommend to this group tonight to say, this is what I want you to take home, this is the takeaway value for you based on you as an entrepreneur and based on your experience with investing? So Pat, can I pick on you to start, and then we'll kind of just go down the row and then we'll go from there.
Sure. Before I answer the question, let me say that after that intro, I'm going to vote for you for the most interesting man in Wilmington.
Nice.
So you got that going for you. Yeah, you know, the advice I would say is that this is a marriage. Whether you're the investor or you're the entrepreneur, look at it as a marriage. You've got to make sure you've got a good fit. There will be hard times. You're going to have to navigate those through together. And that's what ultimately leads to the most successful exits that benefit both the founders, their employees, and the investors. So keep that in mind.
Do your homework before you chat with investors. A lot of folks expect I'm going to come up with a one sentence about my brilliant idea, not recognizing that the investor may have heard that idea 50 times in the last 3 months. It's never easy, and first impressions are really important, and you can build on them. So, hey, Juan Carlos, I just met you. I've learned this about your fund, and I'm really interested. I'm working on something. I'd love to have coffee with you 2 months from now. Will you remember my name, and I'll be in touch with you. So I'm not pitching him. I'm trying to set up the relationship. But as Pat said, it's a long-term relationship, and you effectively are hopefully heading towards a marriage. And so you have to start, you don't kiss on the first date necessarily.
Okay, follow that one.
Yeah, I think because it is a relationship and ultimately a marriage, I think authenticity. Authenticity is extremely important. Authenticity in who you are as a founder, authenticity of the company that you're actually wanting to build, and then within authenticity also means telling the truth about your company and what you do and what you don't do. If we move forward with you and we begin looking for you or your company as an investment, we're going to find out if you're lying about your company, about your progress, about your numbers, and honestly about who you are too, because we're going to talk to people who know you. And it's a relationship. We want to build authentic relationships with authentic people that we like, because entrepreneurship is very difficult. You're going to go through experiences that are very, very challenging when things seem very bleak and like everything's falling apart. And we need to know, hey, that things are falling apart, that you feel safe enough to come and tell us so that we can help you. So I think authenticity as you're building, as you're trying to get capital, and then as we're working together in our relationship as well.
I love that common theme. And Neil, I just want to follow up with you, because what I often hear from entrepreneurs or students is, I hear you on the relationship thing, okay, but it's what do I do and what does that look like? So if you could give more specific advice about building that relationship from the time you first meet someone. Is it sending 250 repetitive emails? Is it stalking them at their door? Is it sending them 12 pitches? What is it that they can do in terms of building the relationship with you specifically?
I think the first step is making sure there's a fit. Not all investors are fits for your particular business. And again, it goes back to research. There are particular investors that invest in certain geographies, in certain industries, in certain groups. So it's important to do your homework. And within every outreach, there should be some value. Add something to it, not just, hey, I'm just wondering if you were thinking about me lately. It's, hey, I'd love to tell you we just locked in our first pilot program. And next week I'm going to be speaking at this event at this place. Any chance you'll be around? Add to the conversation, add to the relationship. Again, these are people at the end of the day. So how do you communicate with people? You don't just walk, kind of dating analogy, just going to go sideways. You don't just walk up to someone you're getting to know and just like, hi, remember me? You're adding to the conversation, you're adding to the relationship. The same thing is true when you're approaching investors.
'Cause I found from my experience that I invest more into people and the team than the actual business, from my experience. Because it's about, do I trust that person? Do I believe them? And are they the ones that I want to be in the foxhole with? Pat, I want to pivot a little bit just from an overall perspective of taking a look at the industry today. And there have been some fits and starts going on now in terms of the investing industry. Can you give us a sense overall, if you were going to pick one word to kind of describe what the industry is like right now, but then give us a little just overview of what you're seeing, what are the trends, what's changing right now?
Chef, can you move the microphone up on your jacket a little bit?
Certainly. How's that? Now I sound like Jim.
So if you'll allow me to use a compound word, I would say coming back. As far as the overall assessment, and my data is coming from kind of a national landscape. At ACA, we have a data analytics committee, about 20 analysts that are measuring and trying to get all the data on everything you can imagine. And keep in mind, what we're seeing is kind of a going back to pre-pandemic levels. I'm talking about 2017 to 2019. What we saw happen, and this is in both the angel and the VC community, is there was a ramp up in the amount of capital deployed, the valuations. 2020, 21 were great years. There was lots of capital. That's what drove up valuations. And then that came crashing down in kind of 22, 23. Now we're seeing it go back up, not to the levels of 2020 or 21. And the other interesting fact is if you look at that by series, the curve kind of goes like this, comes down, comes like this for Series D and beyond. It's the same sort of curve down in the pre-seed, seed, Series A, but it's much more level. And so there hasn't been that ramp up, which is a good thing. But we are seeing capital being deployed, not at the levels of 2020 or 21. And we haven't seen the exits. That's another thing to watch is, there is IPO activity, there is M&A, but a lot of that is at valuations that are below those high. So that's also negatively impacting what's going on.
So Pat, I'm sitting out there and I kind of hear that and I say, oh, I guess there's no money. Screw me, I'm done. I can't do anything. Is that the takeaway?
No,
What's the takeaway?
absolutely not. Certainly 50% of the deals and the dollars have gone into AI. So AI is hot. There's no, arguing to that. And we are seeing investors invest more in the rounds that they are investing in. So they're kind of doubling down on those companies that are doing very well. I think that goes back to some of Neil's points about, you got to communicate, you got to have milestones, and you've got to hit those, let your investors know that. If you are a successful entrepreneur that's hitting your milestones and communicating, it's going to be much easier to get that next round of capital from your current investors.
And Juan Carlos, as you've been looking around and you look at the kind of the landscape, has Idea Fund been pulling back? Are you leaning in? Are you becoming more focused? What's happening in terms of going from kind of 50,000 feet now down to what you're doing and what you see?
Yeah, I think one of the things that helps is to understand as well the life cycle of a fund itself. Typical VC funds operate on a 10-year cycle. The first 5 years, you're deploying capital. Second 5 years, you're hopefully harvesting that capital. And so for us, we're in our third year now. So we've started deploying into early stage pre-seed startups. And it's been exciting. And then now as we're moving towards the year 4 and year 5, we realized, hey, we've got companies that we need to exit in the next 6 to maybe 7 years. And so we're looking maybe a little bit later stage. This past year, we did about 5 new investments, and then we're closing our new round, or our fund at the end of this year. So we've ramped up in the beginning of the year into the summer, and then now we've kind of dropped off a little bit and focused on our fundraising. At the beginning of next year, we'll kick off again and start to invest again. And so that's another recommendation for founders. If you're looking to raise, make sure you know what year the fund is in. Are they actively deploying? Are they towards the end of their fund and they're looking to harvest? So maybe they might not be actively investing. And so we're kind of in between right now. We're seeing a lot of companies want capital, and we are investing, but also I think our diligence time is also going a little bit longer as well, to maybe de-risk a little bit.
And Neil, with Front Porch kind of being now a startup here over the last 18 months or so, how are you thinking about deals? Has that changed over the 18 months? And what are you seeing in terms of the profile that you're looking for?
So I'm an LP in Front Porch. I'm not one of the founding three principals. They are fundraising for Fund 3 right now, and it will be their biggest fund. And we're going to participate in that. And what we like about Front Porch is that 60% of their funds, they invest in other venture funds. So a typical venture fund requires a minimum investment of $250,000 to $300,000. And for anybody, most people that can afford to make that investment, that one investment is a lot. So you're putting all of your eggs in that basket. With Front Porch, they're taking that capital and then meeting the minimums and investing in various venture funds. So now you're getting greater diversity because of that 60%, they're investing in the funds that you would otherwise be able to invest one time in, they're investing across funds. So I think they've invested and they're focused on the Southeast. So they're very much about empowering the entrepreneurial ecosystem in the Southeast with a heavy concentration in North Carolina. So for 60% of the money, you are getting into all of these funds. You're seeing great deal flow, and there's all these sidecar opportunities where you can come off in the side, they'll set up a separate entity for you to invest additional capital there. With the other 35 to 40%, they're investing directly in startup companies. And so you get this really interesting mix of investment opportunities, and you get to see all the wonderful things that are actually happening in North Carolina, South Carolina, Georgia, and Florida.
Okay. And Pat, and just to, I want to level set for everybody, because we're throwing around a lot of terms here in terms of angel and VC and Series A and all that. Can you just level set and give everyone a little primer on, what is angel, what is, venture, and what are some of these differences, and how should we as entrepreneurs think differently about each of those different tranches?
Much for asking me that question and not the VCs, because you get a very different answer. So angels are the friendly people. Right? Before I answer that, let me clarify 1.2 just to make sure everyone understands. So Neil referenced Fund 3, and Juan Carlos said, hey, ask questions about the life cycle of that fund. That's very important to do, but most of these funds have laddered funds. So they might have one that they're harvesting, another one that they're just raising. So if you're that entrepreneur, you want to look at their whole family of funds and look at their experience and where they've been. But generally from the angel community, we like to say that we come after friends and family. So you've taken maybe a little bit of money to bootstrap the company, you don't really have revenues yet, you can't go to the bank and get a loan. So where do you go? You're probably going to go to your local angel group or to the incubator, accelerator, university in the area. They're going to make sure that you're capital ready. You go into that angel group, they'll take a look at your company in a very, I would say, collegial way. They want to help you. They want to see entrepreneurs succeed because that's what drives economic growth around the country, and that's where the innovation comes from. So they're going to help you. They're going to let you know if you're ready or not. If you don't happen to have a company that aligns with the investment thesis of that group, they very well may push you off to another angel group that they know invests in that type of company. So again, there's a lot of discussion. It's very friendly. Angels are mostly involved in seed rounds with a little bit of pre-seed and a little bit of Series A. Probably not a lot of involvement, beyond that. The valuations of the companies are generally between, I'm going to say, 5 million and 30 million or so. Anything beyond that is where it gets turned over to the VCs. And we like to say that angels are the farm team or the pipeline for the VC community. A lot of times VCs won't take an interest until you've got that revenue, you've demonstrated milestones. And so by the NVCA, which is kind of the counterpart organization, ACA in the VC space, they've reported that 90% of the companies that VCs invest in have angel funding. So there is a very close relationship, and it gets a little bit blurred when you have micro VC funds and you have angel groups that develop funds, but it's a spectrum.
So Juan Carlos, because there is overlap, right, between these. So as an entrepreneur, how do I know, who do I reach out to? Do I go to an angel network? Do I go to an early stage VC? What would be the rules of the road if I'm an entrepreneur thinking about how do I make that right match? And how do I figure out who to talk to?
That is a great question. I think the first thing you want to look at is really inward on where you are as a company. If you have just an idea, chances are going to a VC fund right away, it's going to be very difficult to get them to buy into your idea. That if you have just an idea, your best bet is to find maybe an angel who really likes that idea too, who's very passionate about the idea, and cut you a check. You get that check, you get a little revenue, you get some traction, maybe that angel brings in their friends, you scale a little bit more, so that you can go to then the VC and you can say, hey, I got $100,000 from angels, I did X, Y, and Z, now I'm looking to get $300,000 or $500,000 in capital to do X, Y, Z. So you can begin to paint a story for yourself, which I think is probably one of the most important things for founders to be able to do, is to be able to tell not just their story as a founder, but their story of their company as well. So, because it's a lot easier for us as a VC to buy into your story if we see it already started. And so that would be my recommendation, is to really know where you are in the journey of your story, to know exactly who you need to talk to. If you're in the beginning, chances are you need to talk with someone who's right next to you. An angel, family and friends. As you progress a little bit further in that journey, then you want to start looking outwards into VC funds who, again, align with what your journey is looking to do, or your story is the story that you're looking to tell. So you can go get capital from them, and they can join you on that journey in a relationship.
So as they explore these relationships, Neil, one of the things we've been talking about is that the majority of the funding kind of has a center of gravity up in the Triangle versus here in the Southeast. And so how do founders address that geographic perception that the funders aren't here, they're there, and how do I break into that network? What would be the specific recommendations you would give to entrepreneurs that would say, okay, here's how you can best connect into those networks?
That's a really good question. So I've been practicing since '03, and the big concern always was this gap capital in North Carolina and how do we lure in West Coast investors here. And I don't know that we figured that out, and I know we're still trying, and I think we are in an undercapitalized market. And so you now localize that problem to like a coastal problem. It's really just networking, and that's all it is. It's networking. You will find a surprising number of folks that are here, whether they're active, whether they're retired, whether they're working as consultants, who have ties, who've had exits, who have ties to other parts of the country. It's all about networking. And I think Jim, not to sort of, you already get enough accolade. Jim is a direct bridge to RTP and to the rest of the market. And sitting down with Jim, knowing what you're going to ask, knowing where you're coming from, and knowing where you're looking. If you come in with an agenda to someone like Jim, you're going to get, he will be that bridge for you. So it's just a little bit more of a hustle, but the network is there. And in today's day and age, with LinkedIn, with technology, with all these cross-disciplinary interactions and cross-institutional interactions, it's just finding the right door. But it is available. And I think Skillmaker, by the way, is a great example. We've been working with them for a little over 2 years. And the type of technology they're developing, you wouldn't think of Wilmington as a hotbed for AI, robotics, VR, XR, but you've got talented folks here in your community developing it. So they just have to work a little harder to open up doors, and those doors have opened in New York, California, and Atlanta, and it's bringing a lot of attention, a lot of firepower to what they're trying to do. And they're doing it from here, they're not relocating. So it's there, you just have to look a little harder.
And Pat, I don't know, how many angel networks are there in North Carolina-ish?
Probably 10 to 15.
Okay, so how do we as entrepreneurs connect with all of those, or those that might be based in the Triangle? What's the best strategy for entrepreneurs to follow?
So the magic of this is really that those groups are all talking to each other. Jim and I are on a monthly call of all of North Carolina, where all of the different leads are talking about the deal flow and who they're looking at. So the word's going to get out, good or bad, right? What I would say to you as the entrepreneur is start locally. I mean, as close as you can, build the relationship. Even if you don't need capital right now, build that relationship, because just like a great great sports team, they're going to have scouts out there. They're looking at the community, they're looking at the entrepreneurs, they're looking at the innovation, and they want to be first to bat when you're ready to raise. And if you do that, the other thing to keep in mind is all investors really want you working on your company. They don't want you out there fundraising. And probably, if you're the CEO, you don't want to fundraise, right? So they're incentivized to get you funded in your round as quickly as possible. So if you've convinced them you're a great entrepreneur with a great idea and you need, let's say, $1 million in this round, they might only be able to fill that at $200,000. But what are they going to do? They're going to call up their friends, probably in the whole region, not just in North Carolina, and say, we've got this hot company, we've done due diligence, here's the terms of the deal, we think you should take a look at it. And that is an efficient way that we really see, more dollars flowing more quickly into those companies so you can get back to work building your company.
Yeah, I would just add that I think having that compelling story, right, that is both your authentic story for you and what the tie is to the business. And Neil, you mentioned LinkedIn, and we take that for granted, but it really is the lingua franca of, it's going to be the first place where you're getting checked out, right? So does your LinkedIn reflect your story? Is it making you the most interesting person in Wilmington? Is it telling the story of your venture in a way that breaks through, rather than I am just another SaaS company, I am another AI company? What is it that you're doing and how you communicate your personal brand, both through LinkedIn or anything that you're doing as you go out and network? And I would just suggest looking at some of that. Now, there's this new thing that I've read about, and it's a technology, and it's called AI. I don't know if you've heard about it, or any of you have. But I'm curious as to how are you seeing the impact of AI on both sides here? And one column, so I'll go to you first. One is, how are you seeing it being used from the VC side in terms of diligence, sourcing deals, and all of that? I know I have a pitch tool as a professor, and my students can pitch to Virtual Shep, and the virtual me gives them feedback, and I can evaluate them and do it at scale, so that's kind of cool. And then secondly, what are you seeing in terms of, is every company now, AI, this or AI that?
AI every single day.
It's artificial intelligence.
That's what I thought, but I wasn't sure. I use AI every single day. I think if you're not, you don't have to be an AI first company, but if you're not using AI in some way to make your company more efficient, you're going to get beat by a competitor who is using AI to make their company more efficient than yours. And so I use it all the time. I use it for some of my investment memos. So anytime after due diligence, we get all of these documentation from legal, from financial, marketing, everything. I use it to make my investment memo. Don't tell Lister how much I use it, but I use it quite a bit. And then also, from the company side, again, we don't invest in too many AI native companies that are just purely AI or AI infrastructure. But almost all of the companies that we invest in some way are using AI. So I think to be able to, one, be honest with the VC if you're an AI company, or if you're just using AI to make your company better or more efficient in some way. But be prepared to discuss how you're using AI as a competitive advantage and how you're using it as a competitive advantage as well. And if I can make a comment on the last topic as well, something that is so attractive to VCs is when you can build your company without our money. If you are a company that are building, you're getting traction, you're getting revenue, you're getting customers, and you don't need our money, that is very attractive. If you want our money so that you can scale, even better. And that's going to get a lot of FOMO from VCs that are going to want to come in, say that they can give you all of this different type of this value outside of just their money. But if you don't need our money, it's very, very attractive to us because we can come in, we can give you your money, help you to scale. And so that I just want to throw that out there. If you're building a company and you say that the only issue that you have is lack of access to capital, for many VCs, for us, that's a red flag, because that means that you don't necessarily know your company that well. Because I promise you, lack of access to capital is not your only problem as a company.
Yeah, that's really interesting, Juan Carlos, and Pat, I'm interested in your perspective, because some of the things that I'm seeing now are that, it's about getting to revenue now versus getting to raise. And it always has been for a very long time, I have to go raise money. And that's the first thing when you ask an entrepreneur, what's your biggest need? I need to raise money. Now the answer is you need to get to revenue, and how quickly can you get there using AI and not, adding people. And I'm seeing examples of companies that are 3-4 person companies that are doing $5 million in revenue. And so now that's delaying it. Are you seeing that trend at all, Pat, in terms of the impact of AI?
Absolutely, but I would say that it is sector specific, meaning there are some sectors, life science, that revenues may not be the end game if they've got that patent portfolio and a bunch of IP that they're planning on, doing the research, clinical trials, getting 510 approval and all that, and then selling. So there are some exceptions to that, and that's where you'll see kind of some crazy valuations in that. We mentioned, I think Neil mentioned, kind of East Coast, West Coast, and not cracking that nut. I would all say in all of this, there are regional differences. So you got to look at it by sector, you got to look at it by region, and just a little plug, it's a free resource. We produce at ACA every year what we call the Angel Funders Report. That is, we go out to all of our groups, all those groups Shep mentioned, and survey them on all of their investments. The levels, the sectors, the CEO experience, and so forth. Freely available. It's called the Angel Funders Report at angelcapitalassociation.org. If you are an entrepreneur, it's going to be very insightful to you. If you're an investor, it will give you insights on different kind of deal structures, valuations, and all that. So, freely available.
So now we're going to watch a little football and break down some film. I would hope that it was about Duke basketball, but unfortunately, maybe football now. So, but thanks, Jim. Appreciate that. Neil, I want to move a little bit now to what investors look for and what you've experienced with entrepreneurs. And so, as an investor, what do you look at in the first 60 seconds? So when you're looking at an investment, what comes up number one for you?
So I think management team's important. It's that authenticity. Are you saying what you think we want to hear, or are you saying something that's authentic to who you are and what your business is? And to segue back to AI for a second, we see a lot of bullshit around AI right now. And I say that so the knowledge base is, let's get this wrong, Rock with a Q is the data center, right? Their head of data center development came to visit me from Toronto, and they're looking at North Carolina, South Carolina, and Texas to build their data centers. And so we're in AI pretty deep, and we did a bit of a roadshow, and the components in and around supporting the AI infrastructure are enormous. And keep in mind, with AI, we're in a bubble right now. There is a lot of get-rich, easy, quick schemes, and there isn't a lot of substance. So if you say we're an AI business and all you've done is smack ChatGPT on top of some functionality, you're not really an AI business. There are layers and levels to AI and putting this in your business. What we love and what we advise on the law firm side, our clients, is to think about, do you have a business that exists without AI? And can you say, instead of I'm an AI business, I am this business, and we have AI enablement. So it's an accelerator, it's a fuel, it's not the thing we do. We were at Venture Atlanta about 3 or 4 weeks ago, and it was interesting that an early stage track and a later stage track, early stage, almost everyone got up within the first 2 seconds. It's like, we are agentic AI and we do this. And so it was like, pick the industry, put agentic AI on top of it, and now you have a business. We were at the mature track, there was cybersecurity, there was infrastructure, there was good old SaaS. AI doesn't replace SaaS, AI empowers SaaS. It's a different way of doing SaaS. So again, if you're thinking about AI, are you really in AI? So when we see a company as an investor, we really get to the nuts and bolts of whether they're an AI company or whether they're using AI tools, which I think is inevitable. I think all industries should be using AI, but not all industries will be AI industries.
Okay, so don't misrepresent it.
Yeah.
Right. And I'm curious, what's the biggest mistake that you see just time and again with investors when they come to you? What's the most common mistake?
Investors or companies?
I'm sorry, when the entrepreneurs come to you.
It's trying to lie about what you're not good at or what you're worried about. No one expects an early stage business or any to have all the answers. And when you present like you do because you're worried about having a gap in your business plan or being judged because you can't solve a particular issue at a particular time, and you end up glossing over that or lying about it, it comes across as inauthentic and unsophisticated. You can't run this business because you don't know your own gaps and weaknesses. So I think that's the biggest issue. It's, hey, this is what we do really well, but these are the areas I need help. And this is what I'm working on to chip away at it. And yeah, I need some additional teammates. And I haven't found them yet, but I'm looking. Yeah, I need some additional capital, but I haven't found that yet, but I'm looking. But in the meantime, this is the path I'm plotting.
I love that. Yeah, go ahead, Matt.
So, the question, what's the number one thing that the investors are looking at? I agree 100% with what Neil said. Saying that slightly differently, it is really about the jockey, you as an individual, and nobody is perfect. The investors understand that. So they want to understand from you, what are you not able to do? And did you find within your management team a way to round out that skill set? So absolutely it's about, the management team and is there the right fit and the comfort and are they authentic and knowledgeable and all that. But right along with that is your expectations relative to valuation. And the reason this is important, and I want to get this out there because every angel thinks this way. You've probably heard the numbers, but 50% of the companies are ultimately going to fail. Even the best pickers are only getting it right 50% of the time. Then you got 20 or 30% that are going to bring you your money back. But it's really, 1 or 2 that are going to create the home runs. So the angel is saying, all right, I need on average to get a 10x return to cover all of those losses. So if you come in with a $10 million valuation, what's the probability I think you can sell that for $100 million in 5 years? If you come in at 20 million, now you got to get 200 million. So think of it from that perspective. So every bit of valuation does count in how the investor is going to ultimately feel about your company.
Don't ask or don't set the valuation. Go ahead and say, look, this is what I need in terms of dollars, and let the investors set the total valuation. Where do you come down on that as entrepreneurs?
So I've been doing this for, about 7 years or so now, and I tell you, one of the things that I was most impressed with is the integrity of the investors. Most of them, the great majority of angels, were successful entrepreneurs. So even if they could take advantage, they probably are not going to. They're going to say, Mr. and Mrs. Entrepreneur, that's not in your best interest. You don't want to do that, and here's why. They want you to have a healthy stake in the company. They want you to have a pool of shares for management incentives and things. So find those local folks that you can trust and build the relationship with them. We have another inside joke that really is half true, and that is if you're looking for funding, ask for advice. And if you're looking for advice, ask for funding. That's kind of what you're going to get out of the angels that you'll network with.
That's good advice. So now, Juan Carlos, from the venture end,
Just don't forget to ask for money.
Ask for money. Okay. What is it that you look for first, and what do you see as the most common mistake?
Yes, so we're early stage technology. So the single most important thing for us is the founding team. And we look for a team that is exceptional. And what does exceptional mean? It can mean a few things. It can mean their background. Have they built up a certain amount of expertise in a particular industry that has allowed them to develop an insight that they're going to be able to exploit to grow a company? Or are they just an overall exceptional human being that can get into the trenches, overcome? These are typically younger entrepreneurs that might not have the best experience, but they have a certain type of grit that they're going to be able to get in the trenches, overcome problems, and push things forward. Another type of exceptional founder is an exceptional recruiter. I think as a CEO, your job is to eventually get yourself out of the job. An early stage founder, you're the CEO, the chief everything officer. You're doing marketing, you're doing legal, you're doing sales, you're doing operations. Ideally, as you scale and grow, you can recruit someone who can come in and do operations for you. someone who can come in and do marketing for you, someone who can come in and do whatever for you, to where your only role as a company is to be that executive officer, recruiting and leading a team. Company that will return a good return for an investor, you just might not be a fit for us. And so we're looking for companies that can return $1 billion plus when they end up selling.
So one of the questions I get from entrepreneurs many times is, how do I know when I'm fundable? How do I know that I've gotten either myself, my team, my business plan, all of this to a level to where I deserve or it's worth my time to be fundable? How do you answer that question for entrepreneurs?
I don't know. I think it really depends. It depends on, we're General Tech, so we're all over the place in this fund. We have an airline manufacturing company, we have a health tech SaaS company. And so depending on the industry, it comes down to traction. The airline manufacturing company, they don't have any revenue, they're not gonna have revenue for many years, and they're gonna need $600-700 million more in additional capital before they even exit. So, but we still invested in them, even though they didn't have revenue. When we're looking for an investment in another, say a simple SaaS company, we want to see revenue. We want to see that there's a market there. We want to see that you've figured out and talked to those customers, figured out what that pain point is, that you're building a product that solves that problem. You're not building a product that is looking for, or building a product that is looking for a problem. So it really depends, at least for us at Idea Farm.
Neil, how about you?
Playing off of what Juan Carlos said, I think it's market appeal, right? It's market traction. So if you're in a technology business, revenue for VCs, it's at least having customers that are using your product and looking at the pipeline of potential customers and the growth of your business because there is market appeal. So I think that's the big thing if you have a technology. I think with life sciences and biotech and advanced materials, it's showing, it's setting milestones, which are primarily R&D milestones in and around the development of IP, and then being able to communicate how that IP gets commercialized, and then it commercializes into a market where it's not a $20 million global market, it's a $20 billion global market. Sue's here from Nala Membranes. They've got a membrane for reverse osmosis water filtration. Their milestones are scientific in nature, and they've attracted several rounds of investment based on hitting those milestones. And they're at the point now where they have global investors looking at the commercialization because they've now gone from the laboratory into the market, and they're right there at the precipice of making that jump. And so it really depends what industry you're in, but it all goes back to the market. Is there a market for your product? Prove it. Well, the best way to prove it on the science side is, hey, this is what we're feeding into, these are the developments we've made, and then on the tech and other side is, hey, look, we have these customers, and we're early on, we're 3 months in, we've already got these beta customers, this is the ramp up for those customers and into revenue.
And so as we think about the resources that both angel groups and venture funds bring to entrepreneurs, it's not just the cash. So Pat, can you talk a little bit about all the rest that as entrepreneurs they should be thinking about and evaluating, that the investors beyond the capital, what can you bring to the party for them that they should be evaluating you on?
So, one of the big differences between, again, the angel community and the VCs are the angels are homegrown, right? They want to do this locally. In addition to, depending upon the year, the $500 million to $1 billion that my members put into companies, we also estimate that they're volunteering 1 million hours a year of their time to mentor entrepreneurs. They might do it direct. Sometimes they will do it through a economic development group or an incubator, accelerator, or whatever, but they're there and they sincerely want to help you. So take advantage of build that network, and don't be afraid to say, well, I've got a challenge in this area. If you don't have expertise, can you introduce me to somebody? Because I think 9 times out of 10, they're going to be willing to do that. They want to see you succeed.
Okay, so before Jim starts running around and playing, Mr. Microphone here, I've got some quick lightning round questions for you. So, and I want you each just to answer quickly on these, if you would. What should VAT founders start doing tomorrow?
networking. Get out there, talk to the investors in the community.
Reading. It's not easy. Just because we have AI and things distilling data for us, you still have to do the work. So read, learn about your market, your industry, and grow a company.
Sell your product and talk to customers.
Okay. Now, what should they stop doing immediately?
Not telling the truth.
Perfect is the evil of good enough, or whatever the way it goes. Get something out there quickly and fail fast, and then pivot and move on.
You don't have to have all of the answers, so be coachable and make sure you're not on the other side of that.
And final one, what's the single biggest opportunity for Wilmington entrepreneurs today?
I think that it is the ecosystem that all of you contribute to and that Jim and so many others have built. You know, that's what puts Wilmington on the map. You're on the map certainly in North Carolina and up and down the East Coast, but doing all of the things that you're doing with a little bit of luck and a few successes, it will just amplify. So you're doing all the right things.
I don't know if people here get fueled by the underdog mentality, but this market in North Carolina nationwide are underdogs, and I think that drives a lot of people. Your Wilmington especially is off the national radar still, and I think that's undeserved, but that opens up a world of opportunity for entrepreneurs in Wilmington.
Rolling off that, you have the opportunity to be a big fish in a small pond and make a lasting legacy in Wilmington as a founder. So grow your company, grow it big, sell your company, and then pour that capital back into Wilmington and be a leader in Wilmington.
Love that. It's all about outrageous ambition, right? And that is what we're all about. So Jeff, let's open it up to any questions out there. And again, if they don't raise their hand, I'll be out there cold calling.
Hi, Sue Meek. I'm with Now Lemon Brains. So the idea of understanding where the investor is in their fund cycle, believe me, this has been an education for me over the years. I'm beginning to understand how this works after like 7 years of talking to investors. So I've had the experience where I've spent hours, days talking to investors, lots and lots of time. We get to the end, they're like, oh, I love your company, I really want to invest. But we don't have money right now, so not the best time for us. When is the right time to ask that question of the investors, and what's the best way to get that information so you don't go too far and spend all that time and get really excited about something and then have it just fizzle?
I think the first meeting, ask the investor if they're actively investing. If they say no, you know. If they say yes, great. First meeting saves your time. Your most valuable asset as a founder is your time.
And I think most entrepreneurs really underestimate the amount of time that fundraising takes. I mean, it becomes a full-time job. And so being able to run the business and raise money at the same time, prepare very well for that and make sure that your management team is ready for it.
And Sue, I would just respond by saying, look for exits. As soon as there's some exits, that means there's capital that's being deployed, and most of those folks are going to want to recycle it.
Love that. Okay. Others out there, Jeff?
Next question.
I appreciate all you guys coming out. You actually answered a ton of my questions that I had. And so for me, I wanted to ask, as investors, how do you think about the balance between building great technology that is worth investing in and the need to understand the day-to-day realities of the people who actually use it, especially in markets where innovation historically hasn't been a big priority?
Well, I'll respond first by just saying, as the entrepreneur, gold plating of your specs will kill you. It's got to be about product market fit and listening to the customer. You could have the best whatever in the world, but if the market doesn't want that, it's of no use. So focus on customer, 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 and making sure that you're meeting one of their pain points.
I agree with you in biotech and life sciences a lot. People are so enamored by the beauty of the science that they've created. And I don't mean that in a condescending way. I just mean that the science is really compelling, but it's academic and it's got no commercial appeal. So you have to be objective, and it goes back to market validation, is if you want to grow a business and exit or earn a living off of that business, do you have a market that will actually pay for your business?
Because ultimately the question is this a problem worth solving? Doesn't mean it's not a problem. The question is it worth solving, and is it a business or not? What else we got, Jim?
Well, something that we haven't talked about that I was hoping we would is the role of the lawyer who knows all of the investors. The lawyers have to know the investors. They have to have those relationships to say, hey, Mr. Mrs. Investor, I have the hottest startup in town, and I need them to pay their invoice. Will you take a pitch from my hot client to get this done? So can you guys address that?
Neil is the lawyer. I am not. Let me set him up with a home run that he can knock out of the park. And that is that one of the things we see quite often is that early stage entrepreneur says, well, I've got a cousin or a friend that's an elder care lawyer, so I'm going to go to them, save a few bucks, and have them draft up my documents. Do not do that, because you will find that becomes a big, black eye for you as you go on to raise, because no angel group and no VC is going to want to clean up that mess. So it, yes, will probably cost a little more from the start, but get the proper legal expertise, make sure your company is set up properly, you've got proper documentation, the terms with your investors are all, kind of standard, and that will pave the way for your growth and for future investment. Over to you, Neil.
Wow.
There are many different areas of law, and when you specialize, when you're starting a company and raising money, you should find a lawyer that does that. I think it's helpful. It's also helpful for calling bullshit when other people are feeding you information that's incorrect. In terms of relationships and networking, again, since Skillmaker was featured in sort of it was helpful that I actually like Juan Carlos as a person. I don't mean actually in that he's hard to like, I just mean like, I know him and I know Lister, and so it helped when we were negotiating some of the terms to just pick up the phone and speak. Because we get along, we know one another, and it helped to accelerate certain things where if you're communicating through clients, if you're communicating through emails or red lines, it gets lost in translation. So I did find that.
I'm an attorney as well, so don't hold it against me. But working with an attorney who has experience with startups, they're also a first line of defense against bad startups, because they're not going to work with founders who are just very difficult to work with or don't really have a viewpoint of getting funded. And they're also great referrals. If they're working with a great company like Skillmaker, we're gonna take a meeting because we trust what they're bringing to us. And so I think an attorney can be a great resource in deal flow as well. That goes for sometimes accountants as well, but especially attorneys. They're typically working, if they specialize in that area, working with startups that have potential, have traction because they typically can pay their bills, and are looking to continue to scale.
And my experience of having a great attorney like Neil is that they can play the bad guy as well, because these feel like unequal relationships many times with the investors, right? You're asking for something, and you're going to need somebody to ask for things that you may not be comfortable with at some time, and the attorney is the perfect person to go ask that for you. So have that person on your team who could be that bad guy for you.
The typical or standard terms are in that given region as well, because they're doing so many deals. So as a founder, if you're working with an attorney who does deals in that particular region, they're going to tell you deals that are getting done right now in your industry with these VCs or these angel groups are $3 to $5 million. So you're going to show up to your meeting with the VC and ask $3 to $5 million. You're not going to look unreasonable when you show up and ask for $10 million, and you're not going to sell yourself short when you go out and looking for $1 million as well.
There's a question here.
You all mentioned earlier the kind of the old adage, you bet on the jockey, not the horse. How do you tell a jockey that the horse is great, but they're not the right jockey?
Tell them to check back in 6 months. No, I think that's where coachability becomes very important. I think if if the founder just simply can't get the job done. Maybe they have a very strong academic background and they have really good subject matter expertise, but they're not the best business person. If they have enough humility to recognize that, then you can build a team around them. But if they're not, and then you just pass, and that comes down to their company not going forward.
Just a quick comment on that. I've talked with one of our more esteemed VCs in the state about that issue, and he likes to put it very succinctly by saying to that founder, do you want to get rich or do you want to get famous? Meaning, have the title of CEO, or would you rather have the right people in the right slots that's going to bring you money as the founder? And sometimes that's hard to swallow, but sometimes that's where the conversation goes.
And look for a board of advisors. Is there a strong board of advisors that they have established? And that will tell you, have they determined that they need coaching and they need support around them? But if you don't have that board of advisors, then that's always a red flag to me.
We have a question here in the back. I'm in now in the back and I can't hear a damn thing you guys are saying. So can you hold the microphone a little closer when you answer the questions? Thank you.
As a founder who relocated from West Virginia to the Carolina coast and is exploring Wilmington as a long-term home, how valuable is it for a growing tech market like this to attract a platform-level startup, especially one that plans to give back, hire locally, and become part of the community? And what signals should founders like me look for to know that Wilmington truly wants to be that home rather than somewhere else? And we're not allowed to use Jim as the reference because he's already bringing me in a little bit.
He loves to throw me under the bus like I'm recruiting him, which gets me in trouble with the people in Myrtle Beach. So again, please answer a little bit louder. Thank you.
So I think Live Oak Bank is a great example of a local success story in an alternative industry that got into tech and began, really as a catalyst behind many of the entrepreneurial successes you've seen in this ecosystem. Right, so out of Live Oak, spun so many different technology companies. Ohanify, Encino IPO'd in 2019. Raylion, one of our clients, just exited 3 weeks ago. The largest VC, the largest fintech VC, or the largest VC in the Southeast, Canopy Ventures. Its home is Wilmington. It's now a national fund. So I think in terms of a platform, the platform is there. It's just a matter of everyone engaging with that platform and adding to its robustness and dynamism. So I drive in, and it's not a long way, it's 2.5 hours, but I drive in once a month for Jim's events, and it's really not to see Jim, because I can see Jim in the triangle. No offense, Jim. But it's to meet new people who are doing wonderful things here and to see how we can tap them into our network. Higher Networks is here, they're Raleigh-based. Juan Carlos's fund is Durham-based. So the platform is here and people are gravitating towards the platform. It's time for folks locally to engage more with that platform. Does that answer your question?
Yeah, yes.
Did you hear me, Jim?
Yes, I did. I heard you insult me for the 7th time tonight. One more.
Hi, my name is Seaside. First, I need to shout out my alma mater, Go Duke.
Woo!
Yes, sir. So, you know, I started from really humble beginnings, and the amount of money you guys talk about is a daunting amount. I'm applying to accelerators, and the debt that you put yourself in is just a crazy amount that I just can't fathom at my current state. I was just wondering, like, what the strategy is. Is it just trust the process and the people, or how do you go about, just that process, I guess?
So before I was a VC, I was an entrepreneur, and I'm still in debt from being an entrepreneur. But I also had the belief that I was going to become rich as shit as an entrepreneur.
A little louder, please.
And I think it's that you have to be a little crazy to be an entrepreneur. You're taking a massive, massive risk for a massive, massive reward. And if you go forward with fear, you're never going to reach that. The best entrepreneurs have failed time and time and time again until they finally got it right. That's why I think the biggest advice is fail fast. If you believe, if the first thing or first person you have to believe in is yourself. And if you don't believe in yourself, stop where you are right now, because it's going to be a big failure and you're going to be upset with yourself for a long time. But the best thing you can do is believe in yourself. What you don't want to have happen is look back 5 years and say, man, I wish I would have taken that risk. Like, yeah, you might go into some debt or a little bit of debt, but that's pretty small compared to a lifetime of regret as well. I think being a founder is one of the most exciting, one of the most challenging, but also one of the most rewarding things you can ever do. You learn, I have a law degree and an MBA, and I learned more in my 3 years of being a founder than any of my education, anything that I'm doing now, and it has made me 10 times better of an investor, even though I'm a failed founder. And it's going to make me better 10 years down the road from now. I can always pay my debt off, but I can't repeat what I did for 3 years as a founder. And so my recommendation for you to any founder is to go forward without fear. If you're passionate about something, if you believe in a company, and if you believe in a product or a service that you're offering, do it. Because what's the worst thing that can happen is that it fails. Who cares? Like, failure happens. And you learn from it, you get better, and maybe the next time you end up doing another company, you do a product, a service that you learn from that first failure, and that's your success. So try and think 5, 10, 15 years down the road rather than right now today. It's terrifying, but you will never regret going forward with it.
And I would just add, I think this is the most exciting time ever in the decades that I've been around to be an entrepreneur. What we are seeing with this transformation of this technology is that entrepreneurship has always been this linear process, that is sequential. We come up with a problem, we find customers, we develop a solution, right? We do all these things in a linear fashion, and all of that equals time and money. The new world is this way, and you can now be an entrepreneur, and it all happens in parallel. So all of the things that we have done over time that cost us money, we can now be better, faster, and cheaper. And I believe, as an entrepreneur, I wish I could be you and go back, because I think it's going to be an extraordinary explosion of entrepreneurship. And I want West Virginia, I want you to move here to Wilmington. It's the best place ever.
There's one more question here.
I was just going to add, I think you need a plan B. So I think lawyers don't, like, I'm an entrepreneur. I left a large international law firm to start my practice in 2008. I'd been married for 5 years. My wife had been in remission from brain cancer for 2 years. We spent 7 months planning our finances and knew that we could make it for a year if I didn't earn another penny just from saving. But we had a plan B, and we knew when to pull the parachute. And fortunately, things worked out for us. But I think you always need a plan B, and if you have friends, a partner, a spouse, family members, you plan and communicate with them, because if things go catastrophic, they're your safety net at the end of the day.
Hey everyone, Scott Davis with NC Innovation. Prior to joining NCI, I'll leave it at I'm a recovering venture capitalist, so I get to commiserate with Juan Carlos and a lot of the rest of the crew around the state. But my question and comments are around like the path of, I guess, less resistance for raising capital for the entrepreneurs in the room. I can tell you, whenever I was helping manage VC funds, we had a hierarchy, of when folks were applying for our funding, there was the classic portal or webpage they could fill out to get our funding, and no newsflash here. Oftentimes VCs aren't even responding to some of those applications, or it's hard to get in front of them. But comments here that if one of our entrepreneurs, a portfolio company that we had invested in, gave us a referral, you better believe that we were going to hear them out. We were going to give that entrepreneur a shot. If one of our LPs, our limited partners and investors, told us to hear a company out, same thing, we were going to hear them out. And so I believe that there is a point of contact, a point of entry that entrepreneurs can find a more ideal situation to get in contact with investors. And just curious to hear y'all's comments on that.
Well, let me start by saying, again, build those relationships with your local angel group and ask them for introductions to the neighboring groups as well. But let me throw out another opportunity that I think ties to that we haven't mentioned today, and that is non-dilutive funding. Depending upon the industry you're in, and now's not the best time, but go after those federal or state grants that are not going to take any ownership in your company. The SBIR, the STTR, those are a wonderful way to de-risk your idea, your technology, and then get it in front of the investors that are going to say, well, gee, if the federal government vetted this and everything, and they've given them, a phase 2 award and all that, we better take a serious look now. So anything like that you can do to give yourself a leg up against other entrepreneurs, because remember, investors have a lot of different options for where they're going to put their money. You want to separate yourself from the rest of the pack.
Neil? Busted him good.
So, Juan Carlos is with Idea Fund Partners. Way back when it was NC Idea, it spun out the venture fund and it stayed on as a publicly funded partnership. There are grant programs, and so it's another form of non-governmental, non-dilutive funding where there are small micro grants to help you get from sort of A to B or halfway to B. So I would look out for accelerators, incubators, and nonprofits that are really not reliant necessarily on federal funding, but that are there to help seed the entrepreneurial ecosystem.
I love entrepreneurs, and my job is to meet with entrepreneurs all the time. Oftentimes, I meet at these events, and I say, follow up with me. Half of the people don't follow up, half of the ones that do. And I typically, 99% of the time, meet with the founders. I've met with a lot of the founders in here. So sometimes it's just cold emailing the founders, being very simple. Hey, we do this, we've got this traction, would love to talk with you. Oftentimes it's reaching out on LinkedIn, it's talking to Jim, and Jim reaches out and says, hey, I'm working with this founder, you should meet with them. Again, it all boils down to relationships. Just meet people, reach out to a VC, reach out to an angel with no intention of getting funding, just saying, hey, I want to tell you about my company. And at least at Idea Fund, I can only speak about Idea Fund, which is where I work, we'll meet with you. We might not give you money, but we'll definitely meet with you, we'll hear you out. We might refer you, if you're too early for us, we'll refer you to an angel group, or oftentimes we say, hey, check back in 3 months and tell us how, you have KPI 1, 2, 3. Tell us how KPI 1, 2, 3 is going. The best, my favorite founders, one's over there because I think it's every month I get an updated email on how things are going with his company.
2 weeks.
2 weeks, every 2 weeks. Exactly. And that's it. It checks in, says, hey, this is what we're doing, this is the progress we're doing, this is how we can help. There's another founder that I love meeting with, Scale Social AI. He's so good because he tells me what he doesn't know and what he's done wrong every month, but more importantly, what he's learned. And that shows so much authenticity, and it shows growth, and it shows a founder that's willing to get into the trenches and learn and admit that they don't know. So just reach out, email, LinkedIn, and actually follow up and just try to build a relationship. Like we're normal people. We look at Idea Fund, we look at thousands of companies every year. And so that means we actually have to talk to companies. We call them VC fellows. These are oftentimes MBA students or people who are looking to break into venture capital, that they're our first line. If you reach out to me, I might recommend that you meet with them. They do initial scan. If you're a general fit for what we're doing at Idea Fund Partners, they'll pass you up the line and I'll meet with you. But again, my favorite part about Idea Fund is meeting with people like you guys that are working on really cool ideas, that are typically a lot smarter than me, doing a lot more innovative things, and I just get to learn from you guys. I might not be able to give you money right then and there, but you might get money 6 months, a year from now, or on your next company. So it's all about building that relationship in a very normal way.
So I would say get to know the investors way before you need their money. Get to know them here 6 months before you're going to raise a round of capital. That way you can share those updates and you can build that relationship before you're asking for the money. If you have that rapport because you've built this relationship, it's a hell of a lot easier for them to say yes versus, hey, I need a check tomorrow because I'm going to be out of business in 10 days. Well, who the hell's going to invest in the Titanic, right? You can see that it's sinking, so why am I going to put my, $100,000 check into that company if I know it's going to die? That makes no sense. Can we get a round of applause for our speakers?